Hi, everyone. Welcome back to our channel. Today, I wanted to talk to you about who is who in the global financial markets. In other words, who are the key market participants? I think it's really important to understand that for a number of reasons, especially if you're new to the industry and just starting or have just landed on planet Edyta. I remember first time walking into the trading floor at Credit Suisse and being totally overwhelmed, but not only the amount of people, the chatter, the electric atmosphere, but also the acronyms that were being used, and market participants that are being mentioned. I didn't know much about. And at the time, Googling was really not really an option. You can't really have phones on the trading floor either. But I wondered, my goodness, who are all these people they're talking to and about, etc.? What is their role? How do they interact? And if you've never been on a trading floor, it's an amazing experience. I had a beautiful opportunity to work on trading floor, and everyone's eyes are always glued to the screens because this is a highly dynamic environment where fortunes can really rise and fall in a blink of an eye. So you do what you see on films, what you see, often where trading floors are being screened is really truly the case, and it is a very enhancing experience. So I wanted to share some of my knowledge around that and put together a very high level overview and presentation of who the key players are, so that hopefully you'll be able to use that in your day-to-day interactions. But also it may be a refresher for some of you guys who are already fully embedded in the world of derivatives. So the first thing I wanted to mention is obviously what we consider a market. So when we talk about the market, is simply a place where the business is being conducted, where we buy and sell. So you are going to hear a lot about the buy side and the sell side in your discussions, conversations, etc. So I think the more complicated the market and the goods that are traded, the more complicated and sophisticated the participants are becoming. And I feel like the modern financial markets are not only the most complicated, but also have the most money at stake in human history. So it's really, really exciting times to be involved in derivatives, trading negotiations, etc. But let's dive into it. So buy side is it can be an individual or a company who buys financial services, financial assets, or securities for investment purposes. Sell side, on the other side, is your firm or entity that is involved in selling those services. So, on the sell side, we have investment banks, brokers, what we call market makers, and I'll dive into that in a minute in more detail. But on the buy side of the market, you would have those who purchase those services like asset managers, investment managers, hedge funds, mutual funds, etc. What I wanted to flag, which is quite interesting, is that buy side and sell side generate revenue in very different ways. Obviously, two different ways. So, buy side generates money by creating value through hopefully successful investments. The asset management companies would often charge management fees based on the assets under management, and the sell side, on the other hand, earns money through fees, commissions, spreads on transactions, etc. So their revenue is often tied to the volume of deals and transactions that are being facilitated. So when you think about it a little bit deeper, the sell side's incentive is always around the volumes. The bigger the volumes you give them, the more intensified they'll be to give you a better deal, a better option, to create your OTC product, etc. So that's the reality of trading. So the better bargaining power in negotiation you're also going to have. Now, the client base is also very different. The buy side will serve institutional investors, pension funds, high net worth individuals. The sell side will work with a broader range of clients. They would serve corporations, financial institutions, individual investors as well, at times. So I just wanted to mention that because it gives you a better picture and understanding of where you sit on which side of the fence. And I've been on both sides of the fence, and it's super exciting. And I do feel like being on the buy side has definitely taught me a little bit more when it comes to accountability and responsibility, for sure, on the legal side. But I wouldn't be what I am today had it not been for the experience on the sell side. So I really have benefited from both sides of the market. So I'm super grateful for that. But let's dive into who some of these market participants are. So, in no particular order, investment banks. Investment banks are critical, pivotal role in play pivotal role in obviously global financial markets. They are so-called market makers, intermediaries. They facilitate trades. OTC here is our main focus, but they facilitate multiple different trades. They structure products. They manage risk. They often ensure that there is enough liquidity in the market. They help with pricing of derivatives, and they trade globally. And the key suspects here are the names you'll be very familiar with. So Goldman Sachs, JP Morgan, Morgan Stanley, Citigroup, Barclays, etc. Now, on the opposite side of the fence, usually facing the investment bank, would be the hedge fund. That's the slide. Or your typical hedge fund entity. So hedge funds are quite sophisticated market participants. They are investment vehicles that essentially pull capital from various investors, accredited investors mainly. Those investors are pension funds or high net worth individuals. They can be really different type of entities as well as individuals. And then the hedge funds would invest that money through the broker into a variety of assets to generate, hopefully, income for the clients. It's actually, we talk actually in the industry of generating alpha for the clients. The use of OTC markets, they are using, OTC markets to implement various strategies. It could be hedging of risk, arbitrage opportunities, etc., etc. So the terminology that you're likely to hear a lot about is that alpha generation, so that I've just mentioned. So that is essentially a measure of the fund's ability to outperform the market's benchmark, such as the S&P 500, for example. So in essence, hedge funds are built to create and deliver high returns. But they, of course, they come with high fees, and they're not only management performance fees, but they don't always deliver on the alpha, which is a whole different story. But the biggest hedge funds in the world that I wanted to mention is probably Bridgewater, Renaissance Technologies, Two Sigma. There's so many notable names. Citadel, they're recognized for their industry-leading returns and profitability. Renaissance, which I've just mentioned already, but the most popular quantitative firms, and I think they managed just over 130 billion as of end of last year. So we're talking some really big names, big market players. Pension funds are next on my list. They sit on the buy side. They can be either participating in derivatives trading themselves, or they could outsource that. By outsourcing, I mean they instruct the investment management. So pension funds do participate in OTC markets mainly to hedge interest rate risk or manage currency exposures or adjust their asset liability matching. So it's a different angle. And they use instruments mainly like interest rate swaps or inflation swaps. But again, there is no set rule. It really does depend on the vehicle and their purpose. There are some big names, again, here that we can mention that you may come across, like California Public Employees Retirement System or Ontario Teachers. One of the largest, I think the world's actually largest pension fund is the Government Pension Investment Fund of Japan, or the second largest is the Government Pension Fund of Norway. So these market participants are pivotal also to the workings of the market. Their role is slightly different, but you are likely to come across them a lot, especially if you're negotiating ISDAs for banks. Asset managers come next. I wanted to mention asset managers as investment managers as well. So it kind of interchangeably, you will be hearing that asset manager, investment manager. Their role is very important, again, very significant. They are using OTC markets to implement various investment strategies. So similar like hedge funds themselves, but they can manage portfolio for a number of different clients. They may also use derivatives to enhance returns or manage exposure to certain sectors of markets. So everything here is really very much dependent also on the strategy. Bigger names I wanted to mention are BlackRock, Vanguard, Fidelity, T. Rowe, Man Group, obviously. And again, the instruments are they vary across different investment managers. You may have some investment managers that only specialize in trading certain products or have mastered, the art of investing in certain very specific niche markets. So this is why you would go to one asset manager and not the other, because they would have the expertise in that particular strategy, for example. Now, next on my list are insurance companies. Insurance companies use OTC for hedging risk, mainly related to interest rates, currencies, and inflation. They can use structured products as well. They're highly regulated, so there's a lot of regulatory issues that they need to consider when entering into OTC derivatives, but it's very, very common for them to obviously trade OTC. The bigger names I wanted to mention here is your AXA, AIG, Prudential. They would often engage in trading directly or on a bigger platform like Man Group or BlackRock, or through those platforms. Next, I want to mention a little bit off-piece. A few market participants, I'm calling them off-piece because you are going to come across them. They're not necessarily your party to your ISDA master agreement. They can be, but not always. But I think it's important to understand, the industry as a whole. So central banks are very important, play a critical role in global financial markets, obviously. They intervene in the markets to implement monetary policies, manage foreign exchange reserves. They always ensure there's liquidity in the financial systems. These are obviously very high-level overviews I'm providing here. And, their role is significant because they have the regulatory ability to impose certain changes to the way we trade on the buy side and the sell side. So they supervise, regulate, they've got ability to fine, etc. So we're talking here about the US Federal Reserve, European Central Bank, Bank of England, or Bank of Japan. They themselves engage into trading as well as have that power to impact how we trade through various initiatives, policy guidelines, changes, etc. They actually I read a few weeks ago, most popular products that are traded by the banks are not even OTC, they're repo securities lending. So GIMRAS and GIMSLAS or GIMLAS, GIMRAS, yes, rather than OTC. But OTC is very popular as well. I think in the last few years, the securities lending was very, very popular, but that's the courtesy of the initial margin regs. But that's a topic for another film. Anyway, next on my list are corporates, non-financial institutions. So think Apple, Coca-Cola, Volkswagen, General Electric, etc. So these big names do get involved in trading OTC markets. They parties to the ISDA. They often hedge financial risk related to interest rates, currencies, commodities. So imagine if they've got massive payouts in different currencies globally, they want to make sure that they lock in the rates, for instance, so that there is some level of predictability and they understand how much money is going to be spent in which country, in what jurisdiction, and in what currency. Now, I've got prime brokers on the list separately. We already talked about investment banks. There's slightly different, a small distinction I wanted to make here. So not every bank provides a prime broker service, prime brokerage services, I should say. But these prime brokers that I'm talking about here provide traditional prime brokerage services of trade execution, clearing services, financing for hedge funds and other institutional investors. And in that sense, in a traditional prime brokerage sense, they play pivotal role, key role in providing access to liquidity, markets, and various types of quite bespoke products at times. So again, that would be your Goldman Sachs, Morgan Stanley, JP Morgan, Bank of America. And obviously, the documentation you would require for that is prime brokerage agreement, in addition to your usual OTC setup of ISDA, master agreement, etc. So there is a number of notable prime brokers in the world, but the ones that I mentioned, I think, are your top names. Apologies if I missed out on any of the banks that you currently work for, but these are the ones that come to mind. Clearing houses. So clearing is really making a big comeback at the moment. So the clearing houses help obviously reduce the counterparty risk in OTC markets by guaranteeing trades and managing collateral. So they are seller to every buyer and a buyer to every seller, as you say, and you can enter into a cleared transaction through OTC. There are certain OTC products that have to be cleared where that risk is reduced, counterparty risk is reduced through use of clearing houses. So by centralizing that transaction, we obviously have that risk limited. To what extent, again, is limited is a question for another film. I'd love to do that video. Let me know if that's of interest. But the biggest names is your ICE or LCH, CME, that provide obviously trade guarantees, settlement services, and other collateral related services. Now, this list would not be complete if I not mention the big role of legal and compliance advisor teams and KYC teams across the globe. I mean, the outreach of legal teams is beautifully global, and we obviously assist the business and the stakeholders in putting together the agreements. And I always love that. Obviously, without the legal, assistance, there'd be no business really being run, because we are pivotal to getting these documents together, procuring our approvals, getting the ISDA, GIMRA, GIMSLA, futures, options, you name it, ancillary documents ready, KYC reviewed, the onboarding, such a massive shift for legal functions. I think it's often forgotten. So big shout out to all of those who work in the supporting service to the business, where the glam usually is, because without those teams, without that, there'll be no deal. So, but there's also law firms, obviously boutique services, big names like Linklaters, Al Novery, Clifford Chance will get involved. But your in-house legal departments are critical to ensuring that the deals go through when they need to go through. So again, yeah, big shout outs to all of you guys who work in the legal departments. Now, I wanted to mention something, a few unusual other names I've got, entities or entity types I've got on the list before we wrap up. Credit rating agencies, they are important because they do come up often in credit discussions, and some of the entities that you may be facing in your ISDA master agreement may have a credit rating attached to them. So credit rating agencies essentially assess the credit worthiness of the entities that you're facing, including yourself sometimes if you're a rated entity, and majority of banks are rated or guaranteed. And the ratings are crucial in determining the risk and the pricing of products like your credit default swap, for example, and other structured products. So the main credit agencies that you are likely to come across are S&P Global. So that's the big three, S&P Global, Fitch, and Moody's. And they collectively hold approximately 95% of the market. And actually, the S&P and Moody's each controlling about 40%. So Fitch has only got about 15, I think. So they're not they don't have as big an impact, I would say, as the other two. Assessing credit worthiness is pretty critical, again, for the credit departments, but this is something that legal may need to get involved with, especially when you're drafting, for instance, credit rating downgrades for your ISDA master agreement or any other document. Next on the list, I've got, we've got exchanges. Sorry, I stopped there because I wasn't sure if I moved the slides. I did. So we've got exchanges. So exchanges, OTC, they kind of bridges between OTC and listed markets. So while OTC markets are decentralized, they're there is a hybrid exchange now that works like CME or ICE or NASDAQ that can facilitate some of the OTC products or can act as intermediary for clearing and execution. So essentially, these institutions are like a bridge between OTC and exchange traded derivatives. So these are two different products. Remember, there is another short video I did on OTC versus ETD that explains that. But hybrid exchanges that I'm showing on a slide, which I'm hoping you can see on the screen, can now facilitate a little bit more of a mixed bag of OTC and ETD, which previously was not available. So this is something maybe not new, but it's becoming more trendy in the market. And then last but not least, I wanted to mention regulators because obviously I know we talked about central banks and their role briefly, but regulatory bodies oversee the functioning and stability of OTC markets across the globe. They enforcing the rules and ensuring market integrity and all the I think the bigger picture, that we need to make sure kind of works. The systemic risk is reduced, and we're protecting participants from, fraudulent and abusive practices. That's the kind of high level helicopter view these regulatory bodies will have, and they would implement changes such as Dodd-Frank in US or EMIR in Europe or MiFID. So all of these pieces of legislation have significantly impacted OTC markets and generated a lot of work for the lawyers. So super grateful for that. But overall, you may come across various bodies such as International Monetary Fund, for instance, or for International Settlements. They who fosters international monitoring financial cooperation, is very active also in the industry. They issue a lot of different guidelines and have quite a useful website that shows you how much OTC is being traded every year. Same with European Central Bank. So if you have time to dive into these a little bit deeper and have a look at their websites, they're pretty useful. And on the US side, I would recommend the SEC website as well. So the Securities and Exchange Commission, all of these regulators have, same objective in mind: systemic risk reduction, making sure that the market participants can trade safely. I mean, these are big words and big concepts, but by implementing certain legislation, it does actually, introduce a lot of changes, especially to the legal documents, or had introduced in the past, and they continue entertaining us with even more, which again keeps the lawyers out of mischief. So it is always good news. And I think that's it. The OTC financial markets and a quick overview. It's actually taken me a little bit longer than I expected, but I just wanted to mention that each of these that I come up with or listed in this short presentation play a vital role in shaping the flow of capital, liquidity, risk reduction, systemic risk. It's a very, that interaction between them is a little bit like music. It's like orchestrating the perfect symphony. They create that complexity, but also it's really dynamic. And the better they work together, the nicer the music you get to hear, and especially in the realm of derivatives, which is such a conceptual world. So that's it for me today. If you find this video helpful, give us a thumbs up and subscribe for more derivatives news in the near future. Thank you so much for watching, and happy negotiating.